Paying off student loans or saving for retirement? Where should your money be going? This is a critical decision so many Americans have to decide for themselves, but the answer is specific to your situation. I'm gonna go through the 3 criteria you've got to know to decide for yourself, because I wanna make sure you're optimizing your dollars and making sure they are building your net worth. I'm Matt Sorensen, let's build wealth. Now, before we get into the 3 criteria, I wanna make sure we know what's at stake here. I'm trying to build your net worth. We want you to have more assets than you have liabilities. If you have more assets than liabilities, you have positive net worth. For example, if you've got $200,000 in a 401k and $100,000 in student loan debt, you've actually got positive net worth of $100,000. We score points over on the asset side. We have points scored against us, so to speak, on the liability side. And as we get into investment returns on our IRA or 401k versus interest rate that we're paying on our student loan debt, you'll start to make great decisions about where to put your extra money. All right, so let's get into the criteria here. The first one is, do you have a 401k with a match? If you do, you are gonna contribute to your 401k and get the match before you even pay any additional money on your student loan. Now, you gotta make your minimum student loan payments. You're not getting out of that, but I want you to focus all of your investable dollars, all of your excess money first to get the match on your 401k. Let me give an example. Let's say you make $100,000 a year, just so I can do the math here, and your company does a 4% match. That essentially says if you put in 4% of what you make, $4,000, we'll do a 100% match of another $4,000. So now I've got $8,000 in my 401k that only cost me $4,000. That is a 100% return on investment. You should absolutely contribute to your company 401k, get the free money match that doubles your money. This is before you've even invested it, before you've even chosen what fund to put it in, your 401k. You've doubled your money on day one versus putting that $4,000 against your student loan balance that might be at a 6.5% interest rate. You are ahead 94.5% in that example by doing the 401k free money match versus putting that $4,000 against your student loan debt. That is a no-brainer. Put your money in the 401k and go get the free money match. Now, let's say you're working for a company that doesn't even have a 401k account and you're using an IRA, or you've already maxed out the 401k contribution to get the free money match. Do I put more money in retirement savings, or now do I take those dollars and pay off the student loan debt? Now, this is an answer that depends on your interest rate of your student loan versus the rate of return you can get in your IRA or 401k. The math here is gonna reduce your liability of student loans or increase your assets in terms of your IRA or 401k. So let's break it down so you know how to make an informed decision on where to put these next dollars. Let's say you have $10,000 in the year of additional money you could either use to pay off student loan debt or to invest into your IRA or 401k. There's no match, so we're just talking about the rate of return I can get in an IRA or 401k. Now, I'm gonna assume you can get an 8% rate of return. That's the S&P 500 fund over the last 20, 30 years. It shows you can at least get an 8% rate of return, and that's where you could invest your IRA or 401k. Now, this rate of return of 8% grows my money. If I have $10,000 and I'm getting an 8% rate of return, at the end of the year, I'll have $10,800. On the other side of the equation here, your liability side, your student loan, if I take $10,000 to pay down my student loans, that means I will have a reduction in loan balance that I'm paying interest on. So to decide whether you're gonna pay that money against the student loan, I wanna know what is the interest rate on your student loan debt. Let's say your interest rate is 6.5%. And let's say you could take that $10,000 of additional money and pay down your student loan balance. Well, what is that gonna save me that year? The interest rate on that $10,000 is 6.5%. So it's gonna save me $650. Now that's gonna help me. That's gonna reduce my student loan debt. I'm only gonna have $9,350 instead of $10,000. So by paying that $10,000 against my student loan debt, that's reduced my liability by $650. So I've reduced my liability side $650. But because the rate of return I could have got was 8%, that is a bad decision. You have left $150 on the table here in that year, which will be the same next year and the year after, because I still get a rate of return next year on that $10,000, and I still get a reduction in my principal, which I'm paying interest on my student loan. So this compounds both ways on paying down the student loan early or investing the money. So here you can see where math actually matters, okay? This is gonna tell you whether you should pay down your student loan debt versus investing those additional dollars into an IRA or 401k. Now you can easily make the argument here that anytime the interest rate is below 8%, I should pay the minimum on my student loan payments and apply any additional dollars for my long-term retirement savings. But sometimes there are other factors at play, not just the interest rate. For example, let's say you're trying to purchase a home and you're focused on your debt to income ratio. You may need to pay off the student loan debt early to reduce that liability and that monthly payment to increase your purchasing power and your ability to qualify to purchase a home. So it's not always just the math. I want you to think about these other items that could apply to you. Debt to income ratio being a common one, some people will say, even if it's 6.5%, which is a pretty decent rate, I still want to pay it down because I want to get rid of it. It reduces my debt to income ratio, improves my credit score, and improves my likelihood to purchase a home. But all else being equal, I'm generally going to say, put your money where the math works. Look at the rate of return, and as a rule of thumb, use 8% versus the interest rate on your student loan debt. If your interest rate on your student loan debt is 10%, pay that off first. Do not put more money in your IRA or 401k. Go get the free money match, but that's it. Focus the rest of the dollars on paying off the high interest student loan debt. Anything below 8%, I'm gonna say put money in the long term for retirement saving. Let's build our wealth, and we will grow it faster by putting money aside at a higher rate of return versus the cost of debt on the student loan. All right, the third criteria here, and this is kind of a rule of thumb, is deprioritize low interest debt, prioritize high interest debt. And this is any debt really, but student loan debt being one of the most common forms of debt out there that many Americans are facing. I don't want you to stress about low interest debt. Stuff below 6%, don't worry about it. Invest that money, let your otherwise disposable income be invested in growing and building your net worth. When I put money aside and invest it, it scores points on the net worth schedule here. I'm adding assets. If I'm taking that money and not putting it to work and I'm paying it against a 3% loan balance, why would I even do that? That's paying down debt. That's only costing me 3%. The Dave Ramsey crowd, I know you love to do it. Don't focus too much on low interest debt. High interest debt, I'm with you. You are getting scored on, so to speak. Let's say you have someone with $100,000 in student loan debt. And let's say this person has $10,000 that they could use to save in an IRA or 401k versus paying down this $100,000 of student loan debt. Let's say $70,000 of this is at a 6.5% interest rate. That is the current average for subsidized federal government loans. But let's say the other $30K they have are unsubsidized loans at a 9.5% interest rate. Now I've got $10,000. Where do I deploy that $10,000? Say you work at a company that has a 401k match, and let's go back to the example earlier. You make $100K a year, it's a 4% match. So if I put $4,000 down, I get a free $4,000 from my company into my 401k. So that's gonna cost me $4,000, but I doubled my return. That's a no-brainer. So let's take $4,000 off the table. We're putting that in the 401k. Even against a 9.5% interest rate, I'm still dropping money in the 401k to go and get the match. We've got $6,000 left. Do I put more money in the 401k? That $6K is going to pay off student loan debt. That's a high interest rate right there. I don't believe I can get that in the stock market or whatever investments I'm looking at in my IRA or 401k. Again, we want a hard and fast rule of thumb of 8% because we know we can get that in the S&P 500. So in my example here, I'm gonna take that 6K, pay down that 30K, now it's down to 24K, but by doing that, I've actually saved money. This is gonna help reduce the student loan balance, which is costing me 9.5%, versus adding more money in my 401k or to an IRA where I will only get an 8% rate of return. Let's say in a few years, I've got that whole 30K paid off at 9.5%. Now I'm gonna take that extra $6,000 I might have a year, and I'm gonna deploy it again into the 401k or IRA because that 8% rate of return is gonna beat the 6.5% interest rate I've got on my other $70,000. At that point, I'm just gonna pay my minimum payments here. I'm not gonna pay that down early because I can beat that 6.5% interest rate with a higher rate of return in the market, growing my net worth by creating more assets on my net worth statement. Hope this video helped you decide whether you should be saving in your IRA or 401k or focusing your hard-earned dollars on paying down your student loan debt. Please subscribe to my channel. I've got tons of content to help you build wealth. I'm Matt Sorensen. We'll see you next time.